Hello everyone. I hope you all are well and safe at your home. So today we are going to discuss about the types of partnership accounts. Partnership accounts are almost similar to the proprietorship business. However, there are some points which are important to know about the partnership accounts that are like a profit and loss appropriation account. Profit and loss appropriation account is actually a nominal account. It is prepared by the partnership firm. It is an extension of profit and loss account. Appropriation of profit is a distribution of net profit to the partners. The appropriations of profit arises only when there is a profit. Uh, in short, we can say that any amount payable to a partner is an appropriation. It is not a charge, it is an appropriation. For example, like interest on capital, a salary, commission, etc. Now, here is the format of profit and loss appropriation account. So, before getting into this format, let me clear to you the nature of all the accounts. So, the profit and loss appropriation account is actually a nominal account. That means um, the rule for nominal account is debit all incomes and gains and credit all expenses and losses. And the capital account belongs to the personal nature. So the rule for personal account is debit the receiver, credit the giver. So now the another point of view will be like, if anything which is a profit for us will be a loss for the firm, and anything which is a profit for the firm will be a loss for the partners. So keeping this in mind, we will understand the format easily. Now we know that profit and loss appropriation account is a nominal account, and the rule for nominal account is debit all income and debit all incomes and gains, credit all expenses and losses. So all the losses like interest on drawing or any loss transferred to the partners will be credited, and all the incomes like interest on capital, partners commission, partners salary, any reserve distributed between the partners or any profit distributed among the partners will be debited. Now we will see the partner's capital account. In a partnership firm, there are two methods by which partner's capital account are maintained. First is fixed capital method and another one is fluctuating capital method. So first we will see what is fixed capital method. So under this method, the capital of the partner are remain fixed unless the additional capital is introduced or a part of capital is withdrawn. Now, under the fixed capital method, two accounts are maintained. First is capital account and another one is current account. In the capital account, transactions related to the introduction or withdrawal of capital are recorded in the capital account. So it will always have a credit balance. And in current account, all the other transactions like interest on capital, drawings, salary, etc. are recorded in the accounts. So current account may have a credit or a debit balance. Now we will see the format of fixed capital account. So the first account under the fixed capital is partner capital account. So on the credit side, you can see a balance brought down. So if there is any old credit balance of the capital account, that will be brought down here. Next is cash or bank account. So if any partner brings additional capital to the business, it will be entered here like cash or bank. If we introduce capital as by cash, will be written cash, or if he introduced capital in check, it will be recorded as a bank account. And on the debit side, there is a cash and bank account. Same cash and bank account, if any partner withdraws his capital, will be entered here. And next one is balance carried down. In every partner's capital account under the fixed capital method, it will always show a credit balance. That is the balance carried down, which is a closing balance. This is actually a difference between the two sides. Now we will see the second account under the fixed capital method, that is partner's current account. So here's the format for partner's current account. As we can see, a balance brought down in both the sides, like debit side and credit side, with a star mark. This means that it means that any one will occur, either the balance brought down in the debit side or in the credit side. It is actually an opening balance of the partner's current account. So, as we know that partner's current account is made on the behalf of partners, so anything that is an expense for the partner will be debited, and anything that is a receipt for partner will be credited. So, like interest on capital, salary, or commission, or any profit and loss appropriation accounts profit, share of profit will be credited. And anything which is an expense for the partner, like drawings, interest on drawing, profit and loss account, which is actually a share in loss, that will be debited. And the difference between both the sides will be recorded as balance carried down as closing balance. Now we will see the fluctuating capital method. So under this method, only one account is made, that is partner's capital account of each partners is maintained. All transactions are recorded in the capital account. Generally, capital account have a credit balance, but in exceptional case, that is, it may have a debit balance due to heavy losses. So here is a format for fluctuating capital account, that is partner's capital account. So as you can see, a balance brought down in both the sides. So it is actually a opening balance for the partner capital account. And as we know, a partner capital account is made on the behalf of all the partners. So everything which are a receipt or a gain for partner will be credited, and anything which is a loss for partner will be debited. So like cash, if capital is contributed initially, whatever cash is contributed initially will be credited. Then interest on capital, salary, commission, bonus, etc. Then profit and loss appropriation, a share of profit will be credited. And on the debit side, it will be recorded all the drawings, interest on drawings, profit and loss, a share of loss. Then cash account. Cash account shows actually a withdrawal of capital, and there is a balance carried down, which is actually a difference between both the sides, which is a closing balance.
Thank you for watching. Do like, share and subscribe to this channel and hit the bell icon to get notified.